Okay, we start now. Hi, good evening, everyone. Welcome to CFA Society Malaysia's webinar. My name is Sichi, the Society Relation Manager of CFA Society Malaysia. As you are aware, CFA Society Malaysia hosted a few webinars in various topics during this movement control order for the past 6 weeks, such as career sharing, debt capital market, doctor sessions, ESG series of webinars, etc. Today, we are pleased to have Ryan, Head of Investment Product Wealth Management from RHB. Ryan also teaches CFA program at Tunku Abdul Rahman University College. And we have co-host with our Treasurer of CFA Society Malaysia, Chong Jin Yoong, to conduct a sharing session on the equity capital market and corporate governance issue aligned with the CFA program curriculum. I will mute everyone during the talk, continue with the Q&A session after that. If you have any inquiries, you may drop your question at the chat box or click the hand button to raise your hand, and I'll unmute you once it reaches your turn. So now, I'll pass the floor to Jin Yoong. Yes, Jin Yoong.
Okay, thank you, Sichi. So, very good evening, everyone. Thank you for coming for this webinar here today. So, of course, the equity markets, one of the most obvious indicators of what is going on in the market. Now, let me share my screen. And go. Okay, so as usual, of course, I'd just like to put up a quick disclaimer. So all the information and opinions that's presented here, right? It's not a professional advice, not a recommendation, and the speakers, myself and Ryan, they're not representing any organization. These are all personal opinions only, right? Okay, so I'm glad to actually welcome Ryan, who is the RHB Head of Investment Products Wealth Management, for today's talk on the global equity markets in 2020, what a year it has been. And also, of course, we'll also touch on this company called Luckin Coffee. For those of you who are familiar with the China F&B market, I'm sure you've heard of this. Now, without further ado, let me pass the floor to Ryan. Ryan, the floor is all yours.
Thanks, Jin Yoong. All right. Evening, everyone, and thank you for your time to come and join us with the discussions on the 2020. How does the market run so far? I think 2020 is a year of anything can happen, right? It's only that whether you can imagine or not. So 2020, we achieved the end of the bull markets, where we have the longest historical bull markets in the history, which is 132 months, close to about 12 years. This 132 months, a good long 12 years bull run is just ended in February 2020. Okay, and we also have a signals when the bull market is ended, when it has corrected more than 20% from the peak. If it's corrected like 10%, it could be just a normal corrections, right? But it has corrected more than 20, and the worst is actually 37%. We see Dow Jones has dropped 37% as much in the month of March, right? But subsequently, it rebounded very, very strongly, about 30% from the bottom within a few weeks' time. Interestingly, I think the market see a very, very sharp drops and also a sharp recovery. And people are thinking the worst is over. And let's not forget, IMF just say that the world is very, very likely to experience the worst recession since 1930. I think this is one of the very key message that the IMF is telling everyone the worst is not over. It's definitely not over. Okay, so the market, of course, is cheering maybe the easings of the coronavirus, just like it has a sharp drop because people thought that, you know, this is the end of the world because of coronavirus, right? But once the cases stabilizing, people are cheering for it. But people forget maybe what's behind are actually the real economic impacts, right? The virus itself don't kill economies, but the stopping economies does kill the overall growth of the countries. Okay, so I would like to bring everyone's attention to an index called volatility index. Volatility index, if you're interested to find out, just go Google and type VIX, and then you will see the volatility indexes. It actually measures how the fluctuations between high and low, and in the last 30 30 days towards the next 30 days kind of projections, right? Is a very good tools to measure volatility. Why this is important? Volatility index is always measured by the traders, the investors, fund managers to see whether market, where are we now, right? It measures the risks, the fears, and the stress in the markets, especially at these periods. The indexes was peaked at 85 in mid-March, okay? And it has actually just at the level of 17 in the middle of February. So this index is typically range between 10 to 20 in a very normal market scenario, okay? In a very rare circumstances, the indexes will sometimes go to 30, 40, right, 50, and in the middle of the March, just last month, we see the indexes at 85, super high level and super rare scenarios that you all will see this. These indexes is also tradable. Interestingly, it's also tradable where you can buy the futures, you can buy the options if you has the appetite for it, right? Okay, so imagine if you buy a level of 20 and then it went up 400% to 85. But if you buy at 85, within 2 weeks, it came down to 40. So it's whether you have the risk appetite for it or not. Okay, and coronavirus is actually a big unknown with a possibility of resurgence in 2021 or maybe at the end of 2020. Right? I think the World Health Organizations and then the CDCs and also issues a potential virus second wave if the containment wasn't being done perfectly. I think we have seen a lot of Euros and even US signaling that the economy is going to restart without having the proper zero cases. This could actually bring the risk to the countries, but people, the politicians over there, thinking that the risk might worth taking, right? So this virus actually started in China, and China has taken very, very extreme measures to claim it down within 2 to 3 months time, right? To be exact, it's about 2.5 months. But when it comes to Euros and US, we can see that the containment measures was slow. Politicians are very late to react, and now maybe they are a bit too early to open it up again. Okay, so and why is it called a fear indexes? And I will let Jin Yoong to share a bit more on this.
Oh, before I do that, so yeah, thanks, Ryan. Just thought ask you, what are your views, or rather, what are your customers' views of the market right now? I mean, you shared with us the government and regulators' response, but what are the customers' views? What are their risk appetite now?
Typically, I think all of the customers that I met now, they are having a two concern. The first concern is fear of losing the money, right? The second concern is the fear of missing out the opportunities.
FOMO. FOMO.
Yeah, exactly, right? So and we have to tell them, right? You are in a tough time now. Rather than predicting what people normally can't predict because you don't have a crystal ball, right? They are actually thinking that okay, market has came down. A lot of them, seasoned investors, right? They are thinking to actually go into investment grade bonds, US treasuries, safe haven assets like including also gold. Some a bit more speculative investors, for those high risk taker, they actually go into mixed assets. Dividend stocks could be one of the considerations also, but I didn't see any of them talking about go into small cap, go into growth stock. None of them.
Okay, so you were saying this thing called the VIX index, also known as the fear index. Why is it called a fear index? So as you see on screen, there's two pictures here. One is a straight road, flat all the way. The other one is a twisting, turning road. Now, if you were planning to buy insurance, right, under which scenario would you actually buy more insurance? When the road is straight, no likelihood of accidents, or when it's twisting like what you see at the bottom? I'm quite sure most people will say, yeah, the one at the bottom. Why? Because there's more uncertainties, right? So actually, what the VIX actually measures is the volatility, the implied volatility of options on the S&P 500. So when do people buy options? And here, I don't even bother to mention whether it's a call or put. It doesn't matter. I think folks buy options or buy insurance when there's more uncertainty anticipated. So if you look at what the VIX is telling us, as Ryan pointed out just now, VIX has gone up to a new high, right? When in the last 10 years, it has always ranged around this level. So as you can see here, all those points which are highlighted, all these are when there is uncertainty in the market. So VIX is actually telling us that the market is pricing in more and more uncertainty, hence people are buying more insurance, or in this case, options. Right? So are we in a bear market?
Yeah, I think we're definitely in the bear market, but how long are the bear market going to last? On average, just to share, the bear market is going to last about 22 months on average basis. Shortest one at 3 months, right? So whether are we going to have a shortest bear market after the longest bull run, the chances are very unlikely, very unlikely. This whole economics, this whole economic recessions, unlike the previous one, I think in 2011 we have seen the Euro debt crisis, right, which has happened within the financial sectors and governments, basically printing monies and solve that kind of issues. Back in the global financial crisis, derivative and also within the banking has a lot of bad assets, right? So all these things happen within the financial sectors, and printing monies, giving a lifeline to the banks could actually help to solve the problems. But this time around, virus, right? This virus is the biggest unknown towards everyone, and it happens and it halted almost all sectors, productivities, right? All their revenues generations, everything, it has stopped, right? Except a few that are doing well is like Just Go, right? But this thing cannot be solved by just printing money, right? So we'll go through a bit more later. So how bad is the bear market magnitude is going to be? The last one we spoke about, Dow Jones dropped about 37%, and then the average bear market that dropped about is about 42%. So whether are we going to see another lower bottom, or are we going to see 37% is unknown. But what based on historical basis can say is we see a more downside risk ahead from here, because IMF will mention this is the global recessions we have not seen in our lifetimes, and all the government should spend as much as you can and keep the receipts. But whether every government can spend or not, we will go through it later, because all the governments trying to buy their own country out, right? But it's not so simple as that. Okay. But on the good things, if you want to talk to your clients, if you want to know how you should invest, on the good side is if you invest after every recessions, you will see average 166% return in a period of 54 months. So I think that's the good side, because in the long term, market still does go up. And if you can look at the next chart, which we borrow from the JP Morgan to show that this is the historical bear markets and the durations. And this time around, we definitely will see a recessions. We definitely are seeing an aggressive much more aggressive Federal Reserve, and we might see extreme valuations in certain sectors, especially if you talk about oil and gas, aviation, tourism sectors. They might have just suffer the first hit, because the overall industry of their sectors is going to be under the water for the next 3 to 6 months at least, right? And then
So it's
there's,
all,
yeah.
so it's all doom and gloom.
Yes. So yeah, I think the next slide.
Okay. Now, here's the interesting thing I thought I'd share with everyone. So if it's all doom and gloom, now imagine you were Captain America. So I think we all know what happened to him. He went into hibernation. You woke up from a 20-year hibernation. And the first thing you see are these headlines. Stock market, best week in history. Dow and S&P jumped 12% thanks to the Fed. This was from 9 April. And then you turn on the TV and you see Dow's best week since 1938. Now, all these are taken in the last 1 month. So how does that jive with what's happening? Now, to make matters even more interesting, take a look at that snapshot of the TV screen and look at the bottom now. More than 16 million Americans lost their jobs. This is based on the initial unemployment claims. Of course, that number is significantly higher now, right? So there's this funny thing happening that on one hand, you see the markets rallying, right? But on the other hand, the most fundamental economic indicators are now showing red lights everywhere. And I think Ryan is going to talk to us about what could be the reason for this disconnect.
So the market actually move ahead of the real economic data sometimes, right? So as we spoke about it, when the coronavirus first started in China, is about January time, remembers, and the market continued to go up because everyone underestimated the power of the virus. Market continued to go up until end February, and suddenly when it infected and become a serious issues in Italy, in France, in UK, in US, the market dropped sharply in the first few days and it stopped, right? It stops and it started to rebound. All these people are back to a phenomenons back in 2005 or 2015 times when the bad news become a good news, because when the bad economic data comes, people expect, okay, Federal Reserve is going to bail us out. We got central banks behind us. Don't worry, market is doing perfectly fine, right? So that is the first hope of the people, and that's why we see the market recovered very, very fast, and it's a bit too fast and too far from the bottom. The overall market responses that we see are reacted mainly because of the unconventional monetary policies. I think monetary policies can no longer define what the governments overall in the world is doing right now, because they combine all the measures that you cannot even imagine, like stopping your loans for the next 6 months, right? Some even give you free money to SME, free money to corporates, free money to peoples, just to make sure that the economy is still doing okay, right? So all these unconventional policies, other than the 0% interest rate environment, which we are going to see in the next few years, we would see more creative monetary policies coming back, especially from the countries and the zones that are going to be hit. If you look at Malaysia's, we given the stimulus of about 4% of the GDP. Singapore, which is slightly more serious, but the government actually gifted the stimulus about 11% of the GDP. Thailand is about 2 to 3%. But if you look at US, Euro, and UK's, their stimulus is very, very massive. US, the stimulus 2 trillion over itself is actually more than what they have done in 2008, 2009 crisis time. They are currently holding a 4 trillion balance sheets in there. And we wouldn't be surprised if they have another 6 to 7 trillion balance sheets in their books. And they can even buy junk bonds, right? So they can even buy the junk bonds who are investment grade back then, right? So this gives them a bit of flexibility to buy junk bond, which is about equivalent to about 40 billion, right? So they can maybe buy about 40 billion of the junk bonds that give market a bit of rally. But let's not forget the overall junk bonds in US itself is 2 trillion, right? So you can only buy 4% of the 2 trillions, but if this economics worsens and default rate spiked up to about 10%, which is normal during the recess periods, we are going to see that the market is going to suffer the real economic impacts at the later time once they realize that this coronavirus is not as simple, and restarting economy doesn't mean that the economy will grow again. Okay, we learned from a very good example, which is China. They have actually restarted their factories' productivities and all that. But in the next 1 or 2 months and 3 months, we will see how much their PMI, how much their export is going to do in the next 2 to 3 months. Because if they don't do well, the rest of the countries is going to be suffering a lot more, right? Because they are the first one to recover. But at the same time, we all in the world of the interdependent world right now. Every country is depending on one and another. Okay, so if even China is the biggest exporter in the world, also cannot provide a very strong rebounds, we can see that the rest of the countries, right, is likely to suffer more, especially places like US, who, like Jin Yoong mentioned just now, having 16 million jobless people around the countries, and Euro, who are being hit the most, Italy, France, Germany, and all that. But at the same time, they have to deal with the Brexits, right? They have to deal with the Eurozone itself, because Eurozone discussions on the QE always takes a long time because they have too many members, everyone has too many opinions, and all of them wanted to benefit themselves. Okay, lucky or
So,
not, I don't think, yeah,
Ryan, you
the
used the
market
word
is, yeah.
creative monetary policy.
Hmm.
So, would it be right to say QE is no longer special or creative or unconventional? Because it seems to me that this is the new normal, QE.
Yeah, exactly. So QE is like it's like Panadol, right? So it's like, oh, you got headache, let's take Panadol. You got crisis, let's do QE. It's like, it's so normal. Everyone is like doing it right now. Everyone is raising the default threshold, raising the PN17 like Malaysia's. So it's like, okay, it doesn't matter. We just do QE and then do other creative things to make the economic figures looks better. But the actual economic, does it looks better? That is one of the questions. I think I think just a couple of days, we've seen quite a few factories open back, right? So we check with the factories like cements, like the sands and all that. So we asked, okay, so your factories are opening back. How do you see right now? The one thing is like, yeah, we open back, but we got no people buy, right? So the economy has stopped in a way that no people is buying anything, even for constructions. They dare not to start the business, because, or else you would be just like another oil, where you can see a negative prices, right? Because even you open a shop doesn't mean that people will come in and buy. Okay, so even though you open back the factories doesn't mean people will come in and orders, other than glove and the mask right now. Okay,
So,
so
what
yeah,
QE is doing is just raising, or rather putting a floor to asset prices or financial.
exactly, which is they're trying to stop the further slides of the asset prices to a certain extent, right? But their real goal of the QE is actually to, you know, reduce the interest rate, to give more lendings to the business, and to
But
boost
that's
the
already
economic.
at zero, right?
Yeah, exactly, right? So funny thing is, you want the bank to lend more money, but on April 11, JP Morgan raised the minimum credit score to higher to all the new mortgage loans. All the new borrowers also need a 20% down payment to qualify. I mean, this is a tough time, right? 20% sounds so impossible, and they even raised the credit score to much higher and stringent criteria during recessions time. So does the QE really helps to borrow more? The chances are no, because the banks give a slap to the Federal Reserve and say that, come on, you can give me money, right? But it doesn't mean I will lend out, because I will have the risk to take. If I lend out now, chances are the bankruptcies is what, 80%, 70%. I wouldn't do it at the moment, because no people has income uh, to qualify for the new mortgage loans. So this is very ironies and contrast to what the aims of the central banks.
So that brings us
Hmm.
to, I think the word new normal is now being used very often. And also this thing called the modern monetary theory. I'm sure some of you here would have heard of that before. But obviously, I prefer the other more sexy name, helicopter money. Now, how is this different from QE? So I think for all our listeners here, I think we all know that what QE does is that it increases the money supply, yes, but the money, the cash, the liquidity goes into the banking system first, because the Fed or the central bank buys securities from the banks. The difference with helicopter money is, of course, money is channeled directly to you and me, people like us, directly to the individuals, to the consumers. The only problem is that, is this the right move? If I can give everyone a check of 1,000 ringgit or $1,000, whatever the currency may be, why not give 10,000? Why not give 100,000? If 1,000 can only last 1 month, why not increase the amount so that people can survive for the next 12 months, 1 year, 2 years, however long it may take before the vaccine can be found, right? So these are the kinds of, I would say, unconventional monetary policy that is now looking at the way things are going, is becoming more and more mainstream, right? And on that note also, just to tie back to one of the things that we have learned in the CFA syllabus. So yes, we saw the market goes up. One of the ways in which we can see how, or rather whether the market is going up or not, is we look at the index. But I think the problem is, does the index really tell you what's happening in the market? So here you see this is the concentration in terms of the top 5 largest stocks for the S&P 500. So back in 2000, that was the peak, whereby the top 5 stocks constitute almost 18% of the index. Now, the top 5 stocks, and Microsoft is the only company that appears twice, right, constitute more than almost 22% of the index. Now, the thing is, as we know, S&P 500 is actually a market cap weighted index. And of course, a lot of the internet based companies are doing very well when everyone has to stay at home. So of course, this has pushed their prices up. The market cap has gone up, right? And that is also one of the factors that causes the indices such as the S&P to go up, right? So under normal, I would say under normal scenario, the market cap weighted method of constructing an index is actually better. But in this current scenario, whereby you see so big discrepancy between one sector versus the other, I would think that it's actually skewing the kind of information that is being provided by the index, right? Now, so of course, when we look at index, we are looking at it more from a macro perspective. So going back to our CFA reading, Ryan, why don't you talk us through about top-down analysis? We are looking at the equity markets anyway.
Okay. So for the equity analysis, do actually give a very good reviews on how we should actually do analysis, either from top down or is it from bottom up. So we first go from top down. From a top down analysis, we can see, okay, so whether these companies or sectors are over or undervalued, right? So if the oil and gas can go down to -40 per barrels, how does it tell you on the oil and gas sectors? There's no good things on oil and gas sectors that you can tell, all right? So the sector wise itself is definitely got to be beaten by the oil prices movement further. And oil prices is actually by supply and demand and a very true indicator of the economy. US has been producing about 12 million barrels per day, and the country has been consuming the equal amount roughly per day, barrels, right? 12 million barrels. But the reasons chaos in the oil prices that it go down to -40 per barrel, that means you can buy a barrels and then on top of that, every barrels you get a $40. How is that possible? I think none of the people could have ever imagined this could happen, right? Except maybe a few that thinks that oil price might go into negative territory. But this is because the demands in the US has dropped drastically, right? Because the airlines has stopped, factory has stopped, no one is using oil at all. So once the demand has has dropped, the supply side is not in time to stop the productions. And it's not so simple for you to just stop the productions in oil. For shale players, if you know, the shale players will need to do a lot of works before they can stop the drilling for the oils, or else if they stop it abruptly, the drilling process might consider wasted already. Now, if you look at this, you definitely know that you might avoid the shale gas player. Okay, and we also look at the performance attributions to access the results of the fund managers. So if you look at this, how many fund managers can give you positive results, or maybe not positive, how many fund managers can give you a better results compared to the market, right? Chances are very, very little. I mean, market is getting more and more efficient. What happened in US, in Euro, you will know right now, right? And people will do the allocations and studies and analysis at the same time. They will react together with the fund managers. So after these cycles, we will see maybe 5% of the fund managers can outbeat the markets, maybe, right? We will see after this cycle is over. Okay, and fund managers or even portfolio managers or even yourself should also perform industry rotations. Okay, the industry rotations, okay, is very important across every cycles, which I'm going to show you the next slide, the performances of every sectors in the first quarter of 2020. If you look at energy sectors, it's down by 50%, right? If you can smell the something wrong between what's happened in the markets like energy sectors and what happens in technologies, for example, the software that we are using now, right, which is Zoom, right, and it has boosted a lot of usage for Zoom, and people using a lot more technologies. If you look at that, if you buy into energies versus if you buy into technologies, the difference is actually 40% difference. Okay, so if you do a industry rotations correctly, okay, you will save a lot of monies for yourself, for your clients, for everyone's money. Okay, of course the market will still drop. There's not really possible when everyone is dropped and then you can be the only one that is leading. A few stocks maybe like Top Glove, but not every not a single sectors can be spared from the market, because market will just drop as according to the beta relevance to the markets. Okay, so the work from home boosted the share prices of Zoom from about $70 to about 150, and technologies become the least affected, as you all can see, even better than utilities, even better than consumer staples and healthcare. All right, it's like people are moving into a new era, saying that it's either you adapt into technologies or you get replaced. Okay, so another influences, as we mentioned just now, and also discussed with Jin Yoong, the interest rate is going to be zero. When interest rate is zero, okay, the bank's earnings is going to be very, very limited. I mean, how much you can lend out if the interest rate is at zero? Maybe you can lend out at 0.25, 0.5%, but that doesn't give you a lot flexibility to play with. So that is also external influences that could put the pressures in the bank for the next few years. Okay, so I see, how do we perform industry rotation? So we perform studies on the industry rotations on every sectors. I think in the slides that we shared before during the classes, every industries since 1950, they perform differently in every sectors of the economy, right? Economy sectors, we have recovery, growth, peak, and then recessions, which is now, right? So if you are nearing towards the peaks or you're nearing towards the recessions, people do perform sectorial rotations according to the sectors. So I think I can share a bit more later on if we still have time. Okay. And another okay, yeah. So on top of that, other than the top-down analysis, bottom-out is equally important. But just that bottom-out has a lot of limitations that we can see. I mean, in Genting Malaysia's, other than the 20% pay cut that they just announced, which no one has ever thought, okay, Genting is so cash rich, but it still do a 20% pay cut. Imagine what other sectors will do, right? But on top of the pay cuts, Genting also said during the statement saying that they do not provide any guidance to their earnings, to the company's earning, because they don't know how to provide guidance. So if you cannot provide any guidance on the earnings, you cannot provide any projections, you wouldn't have a picture how much the company is earning. You cannot use the price to earning ratios, for example, right? You can't use the price to earning ratios. You can't use maybe a discounted cash flow, because a lot of companies will stop the dividends, okay? And equity valuations will have the limitations on these scenarios, especially if you are talking about earnings, dividends, and all that. So at this moment, people might more prone to price to book value and enterprise value to their EBITDA. And some people who, based on the historical recessions, they will see how fast the companies will recover the earnings, maybe in 2 quarters, 3 quarters, to give up forward projections. But the forward projections again can have a huge variances. If you look at the next slides, the global earnings across the countries has dropped significantly. Okay, so the US, emerging market, Japan, euros has dropped significantly. If you look at the global earnings in euro, there hasn't been growing up since 2006. I mean, imagine, right? 10 years ago, your company earned $1. 10 years later, your company is earning 90 cents. That shows that the zone has no growth, the company has no growth. It's very alarming to a zone like this, because if you look at US, emerging markets, and Japan's, we are still growing compared to 10 years ago, but unlike euro, right? And just being unfortunate also at the centric of a pandemic coronavirus, they are going to suffer more. So if you want to value a euro companies right now, which has very little earnings, who didn't do well in the global financial crisis, and now even have a negative revenues and earning growth, and has a lot of coronavirus cases on that regions, how would you think, right? So the next thing is the economic impacts towards the euro might be the same or even larger than the US itself. Okay, because euro, unlike US, they don't have a very, very strong Federal Reserve who can do anything within one entity. And euro, you need like 20 parties to discuss and then have a 3 days or 10 days meeting until you get something solid to come out. But then it's too late already. Okay. And if you look at the valuations, on the right charts, in the past 25 years, there's a range on the gray bars, and you can see that our current valuations may be at the low side, but again, this is not final. We never know how much market might continue to suffer, and we will never know how much earnings could drop in the next quarter or in the next 2 quarters. Okay, I will do a special talks on the China Starbucks, who has been a very debatable legends towards everyone. Luckin Coffee, the founder, is actually a car rental company's founder. So the methods that he applies is actually opening out as much as outlets, throw the price until everyone rent the car from him, and then he expand the business, and then he raised the price later. His company went into IPO late afterwards and earned a lot of money, and he is thinking to apply the same tricks towards this Luckin Coffee. What went wrong of that company, right? We never know who is the one that behind it, but definitely not single person, and is a group of person who inflated the company sales by 60 to 70%, right? And the company can, from a startup to IPO in 18 months in Nasdaq. Sounds so amazing, right? Just the apps that we all are using now, Zoom, it took about 9 years, right? It took about 6 years for the company to go into IPO before anything, right? And this Luckin Coffee has opened 4,000 outlets in China in less than 18 months. 4,000 outlets in 18 months. Exactly, larger than Starbucks. So how is it possible? lack of corporate governance. Before one outlet gets into profits, they already issues an expansion plan because fabricated sales number. And with
Ryan,
that,
I want to share a
mm,
story. A friend of mine who works in China said that what Luckin Coffee actually does is that they want to have their presence everywhere, such that anywhere you go, let's say you're going to work, you take the ride hailing, right? In the car, you just use the app, order, and then once you get down, you just walk less than a block away. There will be a Luckin stall for you to collect your drink while you're on your way to work. So it sounded really sexy. I have to admit when they were pitching it.
mm. But of course, a lot of things we see is so sexy from the outside, but when we look inside, it's all corrupted, and it's all corrupted. And the auditor is actually Ernst and Young. It all happens when the Ernst and Young, who are supposed to be auditors and need to sign off the 2019 of the annual reports, but they refuse to sign off, right? And every listed companies need to get it signed off by a certain deadline, but because of Ernst and Young refused to sign off, I think something happened to our very familiar 1MDB company before. Um, a lot of auditors back in 1MDB also refused to sign off the company statements. Because you know that if you sign it off and then something goes wrong, the whole company will collapse. Okay, so once the EY stop the sign off and refuse to sign off, market has been speculating already, right? Market has been speculating and it's definitely a poor oversight from the internal boards and management committee, in which this case, going into the next one, in this case, the senior management of the Luckin Coffee is also the major shareholders of the companies. Okay, they have all sort of reasons in the world to corrupt together, okay, to make sure that the returns of the companies and the returns of the shareholders are maximized. That's why all these principal Asian conflicts that we all study is very, very important. It's because the risk of poor governance, like we see today, can cause the companies go into bust. And that's why we're saying that short sellers are very, very important in the market. And if you don't know who is Muddy Water by now, you should. Muddy Water is a very famous so-called sharks in the Wall Street. What they tell everyone is they are doing the things that Wall Street don't do because they speculate and they hunt those companies who have accounting issues, who have disputable or auditable accounting treatments, who have a questionable business models. A lot of companies that they targeted are all those companies who are in huge risk. In these cases, Muddy Water also targeted the Luckin Coffee and in January, and then a couple of months later, I think 1 or 2 months later, I think 2 months later, Luckin Coffee cannot sustain, and that's why it went bust. So short sellers are very important because they help the market to discover the true prices of the shares, the true prices of the company itself. Without the short sellers in the market, every company will sound very rosy because you don't have a sharks, right? I think in Malaysia's we stopped short selling a couple of weeks ago after the sharp drop in the markets. So and all this doesn't really helpful to help the market discover the true pricings of the shares in Malaysia, because as again short sellers, although a lot of companies hate them, to be honest, but we need them, right? Without them, we will have another big company which called Enron, which was bankrupted before. This Enron last time used to have 700 billion market cap back in 2000s, year of 2000s over, and it bankrupts, right? It bankrupts. The market was wake up in a sudden, and last time, uh, the big four accounting is not big four, it's big five, right? One of the accounting which called uh, Arthur Anderson's, right, who was the auditor for the companies, also become bust because no people find that company do business again. So the big five now become the big four in a company. That's why you see that EY, Ernst and Young, Die also don't want to sign the papers, because if they sign and something goes wrong, it's going to be bad for the companies. Okay, so the governance is essentials, and the governance within the companies itself is the key towards the company to growth in a very sustainable manners over the long runs. Otherwise, you will have short-term success, like Luckin, but over the long runs, it could be just uh, it could be just the another rosy pictures at the front outside.
So, Ryan,
Money will, yeah.
in this kind of economic environment where it's so bad, right? Is ESG important? Because during good times, some companies will view ESG as creating additional costs of doing business. I would say some lah.
Yeah,
I mean, a lot of companies
yeah,
have adopted it. Yeah.
yeah. So I think ESG definitely for me, especially the G. If you talk about environmentals or socials, it was a bit depends on everyone's, right. But the governance is the key towards every company, because the governance, you have the business models in a solid way rather than a fraudulent way, right? We have seen a lot of companies, just like maybe another our neighbor countries, one of the biggest oil traders in the world, Hin Leong,
Oh
uh,
yeah.
yeah,
Yes.
is getting into trouble right now because of this, and the head of tradings there has so much power that he can hide billions of trading losses, right? And that is definitely something not right somewhere, because nowhere in the world you can hide an amount of losses like this. Okay, so some people quoted noble groups or whatever. In fact, yes, it is, right? So if the corporate don't have a very strong governance, the losses gonna be snowball and snowball and snowball until the day that it cannot sustain anymore and it bursts, and the impact's gonna be massive, and it's gonna be nasty also. So governance, definitely. I think everyone, if you want to buy a shares, buy it from some company we have strong governance, not something we have like one fella can be CEO, CFO, and also the major shareholders. So these companies you better don't buy. Okay.
Okay. So, oops, where's my mouse? Yep. That sums up our talk here today. No, so just to wrap it up, we start off by looking at more at the macro picture, how the equity markets is doing, the extreme volatility, whereby we can have really good headlines coming out and then really bad headlines. So that goes to show the kind of volatility we are seeing in the market now. Of course, from there, we move on also to all the unconventional methods employed by from both a fiscal and monetary point of view in order to support the market. And of course, we ended that up by looking at an example of a company that has gotten into trouble because the G in their ESG wasn't functioning properly. So I think we have reached a point where we would like to open the floor. Open the floor to anyone who has questions.
Yeah, I think I
Stuart?
saw one of the questions earlier. How could the negative 40 happen?
Oh, yeah.
Yeah. So as I mentioned, if you continue to produce something, right, you have to store it somewhere. And in the US, all the storage are full. If you pump it somewhere, if you pump it, right, you have to store it, and the storage is a cost, transportation is a cost, and now you have to beg someone to store it for you, and it's also a cost. Also, that's why even though you pump it up, you want people to buy from you, it causes the negative prices. That means the market was distorted in a way, right? But it wasn't a blip, but it was showing that the oil was that bad. The oversupply was that bad at that time that demands cannot even uh, follow up, and the demands cannot even catch up with the productions at all. The market just went haywire on the oil markets. We hope the problems will resolve, of course, right? Some people ask me, will we get paid if we pump RON 95? The answer is no.
I hope for
Right. So
that too.
unfortunately, the answer is no, right? So refinery and everything is still have cost. And
I think we
okay,
have one
so yeah.
question from Daniel. Um,
Okay, hold on. I can unmute Daniel now.
Okay. Hi guys. Hi
Hi,
everyone.
Daniel.
Thanks for the
hello,
Hi.
talk.
Daniel.
Very entertaining. Just one question and then one from earlier on because it wasn't answered. The 40 oil price, right? Was it backed by a lot of volume or was it very thinly traded at -40?
It's actually a volume, right? So even though after the -40, it went up to about +1, but again, after it went up to positive territory, it still go back to negative after a while. So this actually is not really a blip. It's not a blip in the system, but it's actually reflecting the prices was that bad. And if you are oil productions company, you cannot just stop productions like that, because if you stop it like that, your machines, your equipments, your everything is gonna be bad, because for you to recovers the machines, you need more efforts. Just like constructions, if you stop now, if you want to restart it, you need 1 month to clean it up, or you need 2 months to clean it up before you can start constructing it again. It's same things to the oil well. If you stop now, right, without a proper planning, if you want to reopen back, it might take you 3 months. So they can't stop pumping like that, and therefore they have to continue pumping even though they are bleeding in that way. So those are they are caught between a rock and a hard places in that sense.
Yeah. I think there's always a danger that if you shut in a well, you might not be able to reopen it anymore because it's blocked. And then you lose all the potential revenue there. So a lot of oil producers, they're just pumping at a loss just to keep workers on a payroll and just to keep the whole system running. So
Yeah.
this ties nicely with the next question I have. It's actually not a surprise that when the US shut down the economy a month, 2 months ago, and China shut down, this should have been foreseen, right? That there was going to be an oversupply. People were talking about it, but it only happened over the past 2-3 days. We started to see huge dislocations in the markets, right? Oil futures going down to -40. The storage is close to full, it's not so full yet, it's like 3 weeks away. So the general question I have here is, why are people having such such difficulty seeing the tough times ahead? Like the share price keeps going up, all the news and all the outlook is all negative. But the market seems to be in its own party. But everyone who is rational knows that, you know, when you shut down an economy like this, first of all, the restart is going to be hard. It's not going to go back to what it used to be. It's just a doom and gloom outlook for the next 6 months to 1 year. But then share prices keeps going up and up and up. So what's going on, and is it because the Federal Reserve is propping out the markets? And if so, how are they actually doing that?
To answer your questions, I think the overall question is why the market go up. Okay, the
So
first round of the sharp drop and drastic drop of the markets, if you ask me, is due to a lot of forced selling. Okay, when the market start to drop about 10 15% to 20% from the peak, it happened too fast that a lot of the people who are using leverages, companies who are using leverages, they get to force sell also, because they never expect this to happen. So the rest of the 10-15% drop from there was because of force selling, right? And second, people are very concerned of the coronavirus because they don't know what will happen, right? So once you have fears, you have the market sentiments, and you have also the force sales at the behind to cause the drastic drop, people move into lockdown. Lockdown give them some time to think. Okay, so like, oh, okay, so this is lockdown. Seems not that bad. Maybe we can open up economy because Trump say we can open up economy and 1st of May. Or last time he used to mention during Easter. So a lot of these kind of people who are relying on sentiments to trade the markets always move based on sentiments. So after that, because the market say, okay, short selling is done, is overdone, right? the market it's better right now. Let's see the things to recover. People never think that what happens after the coronavirus ended, because people don't see how it's going to impact. This is not, I mean, it's not easy to see what's happened behind, because if it's easy, everyone would have done it, right? Market wouldn't be so in the manners that, I mean, market will be in a very super efficient forms, right? In the CFA labels, we talk about weak form, semi-strong forms, and strong, right? Definitely we are not in strong form. In a lot of countries, we are in weak form, because the education levels, experiences, who will have thought that what will happen after the economy restarted? Because people think that, okay, if my productivity is resumed, my GDP will grow. But your restarting the capacities and productions doesn't mean or doesn't equal to your economic will growth, and market will take time to realize that. I mean, how many people would know that, right? Maybe 0.5%,
I
right?
see.
So that caused the disparities within the markets who always move on sentiments.
So you're saying that until the next report card comes out, a lot of these impacts are lagging. They have very non-linear relationships. So people need a bit longer to process what is happening before it's reflected in the stock prices.
Yep. So market always take the time to digest and to really reflect what's coming in the next 3 to 6 months. And also from the technical perspective, if you look back through all the recessions, there is always a rebound. No matter how sharp the first drop, there is always a rebound. If after the rebounds, there are subsequent drop on the wave 2 and wave 3, because rebound is normal. Just like when you're having a bull market, a technical correction is normal. So a technical rebound during the recession is also a perfectly normal situations. Property crashes. Okay. So property tends to always correct by itself. But if you talk about how property crashes, you have to look back the real income of the Malaysians, right? I think the real income of the Malaysians doesn't really grow in the past 5 to 10 years. I mean, 10 years ago, fresh grad started is 2000. 10 years now, fresh grad started is 2005, maybe, right? But the real income doesn't really grow that much. When the real income doesn't really grow that much, the money that can spend on the property is definitely lesser. Okay, so if you talk about property markets that will have corrections, yes, property market that is above 1 million definitely will have corrections. Property market below 300,000, I don't see any potential significant corrections from there. Okay, so it depends on how do you think, and property market crashes is a very general term, because property, it depends on locations, it depends on the places, depends on the prices range and all that. But if you talk about bungalow, yeah, we see bungalow who was being sold for 10 million now asking for 6-7 millions, which is 30-40% corrections from the luxuries. Okay, so if you want to buy properties, maybe you can look into a middle range or 1 million if you can see some corrections.
Sorry, I see Justin, he raised his hand.
Justin,
you have a question?
Hi, Jess.
Okay, probably not. Probably he accidentally pressed the icon.
Okay, so Zaki asked the questions. Correlations spike amongst all the asset classes in March. Yeah, so the correlations across the assets does go up during the early corrections of the markets. The only one that not moving so much together, if you can identify, is government, which is government bonds, treasuries. Okay. Second thing, which has a bit of neutral correlations with the rest of the asset classes, is actually gold. And the third one, surprisingly, came to my notice, which is Bitcoin digital coins. If you look at digital coins nowadays, they are still standing at about 6,000 to 7,000. So whether this digital coin can be a new asset classes moving forward, or defensive asset classes. I don't know now, but it could be interesting to find out. At this moment, if you are a safe havens investors, I would say definitely top-notch investment grade bonds, because for example, Malaysia's, I think that the Bank Negara is going to cut 2 or 3 rounds, or at least 5 more rounds in the next 1 year or two, to boost the overall economy. So they did give a very strong support. Not only Malaysia's, I think China bonds also will have a lot of potentials to appreciate, especially the good bonds, if the central banks continue to cut rates. All right, and gold, although some people still upset, but remember, gold was only 1,005 earlier of the year, and now it's at 1,007. So if you looked at it, I think the overall gold is still outperform the rest of the asset classes. What else? Fear is one of the things that deter consumptions, which causes resumptions. What can reduce fear? Nothing can reduce fear except time. Because now if I ask you to go and take flight, you wouldn't go and take flight. But 6 months ago, I give you free flight ticket, you will probably go. Because the only thing that for people to forget about fear is actually time. When the time goes by, and the people will forget about coronavirus once everyone is getting 0 cases, okay, and there we'll see the resumptions of the economy formally after that. Until then, I think within the 6 months, if you suddenly see a country got 100, 200 cases, or even you see like suddenly Singapore tell you after 6 months, hey, we have 100 cases, we are all being scared. I mean, it's a human reactions. Why is China, Russia coming out with their own gold-backed coin? Okay, China.
Yeah, sorry, Ryan, go ahead.
Yeah, sorry. I think a lot of people trying to come out their own commodity traded in their own currency. So China actually come out the oil futures or oil commodities traded in renminbi. They are trying to do away the influences from the US dollars. As you can see, the US dollar is actually dominating 70 to 80% of the overall markets, and how powerful the currencies, as you all can see, US can always raise the debt to nobody business without being questioned, because they wouldn't be so concerned on the budget deficits anyway. They are deficits until that terrible territories, right? Unlike Malaysia's, for example, if we do this kind of stimulus, our budget deficit is going to be at least 0.5 to 1% lower, right? But US, they don't care, right? And all the rating agencies are with them. No matter how they raise the debt ceilings every year, it doesn't matter, because their country rating are still solid. So because with their country rating still solid, the US dollar strength is continuing to be there, and therefore a lot of countries are trying to do away with the influence of the US dollars, because it's going to be tough if US dollar continue to go up, for example, and then the commodity prices continue to go up. So people are trying to create their own currencies back commodities lah. Okay.
Just to add that, I think it's more of a geopolitical question, whereby of course everyone wants to be the number one. So US, given all its trouble, it's still the number one in the economic game. I guess what China and Russia and a lot of other folks are trying to do is sidestep that, right?
Yes.
Gold, oil is all priced in US dollars. So what they're trying to do is to have an alternative. I don't foresee the US dollar losing its eminence in the near future, but it's heading in that direction.
Okay.
So, okay, I just see the note that we can take one last question, and we actually have the poll up on your screens. So hopefully you can take a look at that and also participate in that. One last question.
Okay, one last question from Justin. Justin, The floor is on you now.
Someone recommending a book.
Rise of
Hey guys, good evening.
Hi, Justin.
Hi, hey guys.
Hello.
Very interesting topic, very topical. Right, I probably have two questions here. I think one is on now we started to see more corporate scandal and corporate fraud, right? As economy get worse, are you expecting the fraud cases to be more and more in the coming months and years, right? I think that potentially number one question I have on top of my mind. Second question I have on top of my mind is that, you know, as an accounting graduate myself, the first auditing class that I have in university is always about, the first assumptions about auditing is audit is not here to detect fraud, right? So audit will be very ineffective when it comes to management collusion, right? But when it comes to the actual case, when fraud really happened, the first fingers that we point to is always the auditor, right? So I can see there's a huge mismatch in terms of what auditors supposed to do versus the public perceptions, what auditor should be doing, right? So any feedback on that?
Okay, so it's not definitely not auditors' job to find out, but auditors could be very useful to determine and identify what's the questionable accounting practices. Okay, as I mentioned, the true mechanisms that can stop the frauds and all that is within the internals, because the internal mechanisms, the internal committees is the one that need to stop the frauds at the first place rather than the auditors which come in and find out a questionable fraud which is too late already. So it's never the auditor fault. It's never the auditor faults, right? But it's always the lack of internal governance, strong governance to actually clear up the path for a better business model. Other than that, I don't see how auditors, because auditor you only audit right after that, after what has been done, what has been reported, is not auditor problem for sure lah. So don't worry if anyone blame you. I don't see that. Okay, but if you talk about whether there will be more frauds and all that, the frauds happened before, or what to say frauds, maybe creative accounting methods was being applied before, when when it happens, because it's like when economic stops, everyone's suddenly short of cash, right? And cash is like the oxygens to the human body, and when everyone's short of cash, right, some just like when you have lack of oxygens, your body will have problems somewhere on. So whenever this problem happens, they will attack the most how to say vulnerable post organs at this moment. So same thing, if you don't have cash, if a corporate or if a whole supply chains don't have cash, the companies that have questionable accounting methods, or who has inflated their sales or whatever receivables and all that, will be most prone to these kind of issues, right? So it's not that during this time happen, is that they happened before, okay, but it was being discovered now because they can't hold it anymore, just like the Hin Leong things lah.
Right, interesting that you mentioned about the importance of cash, because we are also trying to organize another upcoming webinar, but that will be sometime next month, just for everyone's knowledge, that you actually focus on how important cash is. It's always been important, but even more so in this kind of environment that we are in, right? So the details will be up soon. Now, you probably can see on screen, there's this huge words, what's next. I'm not talking about the market, I'm actually talking about the other upcoming seminars, webinars. There'll be one on this Friday, 24th April. This is the masterclass where I will be speaking to Aaron Key, who is the Chief of Staff of Carson. So this is the car trading platform, the digital platform. And for those of you who are interested, well, I think you have already seen the details in the emails that were sent out. And then following on from that, on Monday, 27 April, we have looked at structured warrants together with Ming, and also, of course, our director, David Miao, and how that can be useful in gearing up your portfolio. So if you are available and free during the time, do join us for these webinars that we have already lined up for you. And we also have a lot more, but this is the two immediate ones in the calendar. So with that, I think, first of all, let me thank Ryan for his time, for sharing his views about the markets. Interesting times now, definitely. And so, yeah, so I think that's all that we have for tonight. Thank you, everyone. Sichi, I think the poll has, okay, yeah, the poll is running.
Yep,
So
the poll is running.
Okay, so before you all leave, hopefully you can also participate in the poll. Again, thank you very much for your time. So I hand the floor back to Shichi.
Yeah, thank you, Ryan and Jin Yoong again.
Thank you.
We will end the session now. Before that, thank you to all members, candidates, and chartered pending who attend this webinar. Hope everyone stay safe, stay healthy. Bye and good night.
Okay, good night.
Good night.